price of oil is rising higher, with the world cut off from a fifth of global supplies of oil and LNG. This is Macro Matters, and we're talking about what the Middle East conflict could mean for the US economy. More vessels have come under attack in the Gulf this Thursday, while a US government plan to escort tankers and provide insurance hasn't yet materialised, meaning the price of Brent crude is heading towards $84 a barrel. At the pump in the US, diesel has hit an average of over $4 a gallon, the highest since late 2023. That could mean the rise in inflation might take a summer Fed cut off the table. Well, Jeff Schulze is head of economy and market strategy at ClearBridge Investments. Jeff, how concerned should we be about this impact of energy prices on the US economy?
Well, we shouldn't be that concerned. For every $10 barrel increase that you'll see in oil, it should shave around 10 or 15 basis points off of this year's economic growth. And a key reason for that is the U.S. is a lot more resilient than it has been over history. First off, the U.S. is now a net exporter of energy, whereas previously it was a net importer. So although higher energy prices does take away from the consumer and the consumption bucket of economic growth, you will get some of that back through higher energy production and potentially more employment in that sector. Also, the U.S. consumer spends a lot more of a share of their wallet on energy than historically speaking. So when you look at it, percent of consumption and energy goods and services, it's about 3.7%. That's well below the 5% levels that we saw in 2022 when the Ukraine war began, well below the Gulf War, which was around 6%, and back in the 70s and 80s, it was anywhere from 7 to 9%. So because they're spending less of their wallet on oil, it just makes the U.S. economy a lot less affected by energy price spikes. So while there will be an effect, it's not going to be as bad as what you're seeing in global economies that may be net importers of energy products.
Does that mean, though, that companies whose customers are lower-income Americans should be worried as higher gas prices takes a slice out of their spending?
Well, it will be a bigger share of their wallet. Everybody's inflation is different. But one reason why I'm not concerned about the low to middle income consumer this year is that you are going to see the peak fiscal impulse of the One Big Beautiful Bill hit here in 2026. It's about 0.5% of GDP that will be going towards consumers, and a lot of that's going to be through higher tax refunds as we move through the next 3 to 4 months. So I'm expecting much more of a uniform consumption picture this year than the K-shaped consumer that we've seen in years past, even if energy prices are going to spike gasoline, which will disproportionately hit that lower income consumer.
How will this shake out for the Fed, though? Might a spike in gasoline force them to push a cut back?
Well, Fed fund futures have already taken out a full cut from 2026 expectations. Now, the market is expecting 1.5 cuts this year, but I do think that the Fed will be able to support the economy, but we maybe need to push back when that first cut ultimately comes. Instead of being June or July, it may be closer to September. But ultimately, when you look at underlying inflation before the Middle East skirmish started to happen, there was a lot of progress. Core goods inflation has been pretty negligible. Shelter inflation continues to move down. And supercore, which is the Fed's preferred measure of demand-driven inflation, it was hot in the last couple of prints, but that has a really strong relationship with wage growth, and wage growth continues to moderate. So although this may push back Fed easing, I'm still expecting the Fed to cut here in 2026.
When the attacks began, investors sold off US Treasury bonds when we might usually expect them to act as a safe haven. What's going on in the bond market? Does that show nerves about the cost of the war and the impact on the spiraling US debt?
Well, I think it's two things. I think first off, if these Fed cuts have come out of the market, that's going to be pushing up where the Fed funds rate will ultimately sit, which tends to push up long-term bonds. But also, given this inflation uncertainty and how long this disruption is going to occur, investors are requiring more inflation compensation as a result. So that's a key reason, in our opinion, why you've seen the long end push up here in the U.S.
Can forecasts for the US economy's growth remain intact if this goes on?
It is. This year, we're seeing support for the economy that you rarely see outside of recessions. Right? You've had the Fed that's cut 175 basis points over the last year and a half. And you also have that peak fiscal impulse of the One Big Beautiful Bill, which is close to 1% of GDP. So when you take that and you combine it with the AI investment wave that's taking place, yes, GDP growth may be marginally lower because of recent events, but we still think the U.S. economy will grow in the mid 2% range on a real basis here over the next 12 months.
That was Jeff Schulze of ClearBridge Investments. Don't forget you can watch more videos on Reuters.com.